Well, good evening, everyone. This is AJ Monty, and I'm the Chief Market Strategist for the Market Guys. We are starting right now our open house Q&A session, and if you are brand new to the Market Guys web seminars, then let me lay some groundwork for you here before we get started. Number one, you can ask me questions, and to submit your questions, excuse me, you would go to the Q&A box at the bottom of your box there on the little window, and you can type in questions for me that I'll take. Please wait to be prompted for that if you can, because I have a scrolling Q&A box, so I'm taking stock symbols as well and questions, so I'll be able to see the last questions coming up with the last stock symbols. So that also applies to your being able to submit a stock symbol to me. You can do that. Again, when prompted, it'll be best for you. If I am not picking that up, I'm okay with you putting it in multiple times until I see it. That's worked very well for some folks in the past, and that doesn't bother me a bit. And as we start off in the session, I generally give a market overview looking at the broad-based indices and showing what's been happening in the market. Now, one thing is, if you go to the Market Guys Facebook page, that's, of course, if you're a Facebook subscriber, you can look for the Market Guys. You could like that page, and I will be putting out reviews and some information periodically, not all the time, because I want to put out the information that's important, and that's a great way to get an alert from me. If you're a subscriber to our Oracle services, then you already know that I send out trade alerts once a week, and I put out the weekly market report, which is a review of the week prior. I usually record that on Friday, and Bill posts that by Saturday morning, so you have the whole weekend to review that. Now, last Saturday, I put out an alert on the market. The week before that, I put out a warning really to folks, letting them know that I thought the market was getting ready to break down below this key trend line. I'll review that for you one more time here as we look into that. Back here on November 15th of 2012, we pivoted up and then broke over that blue line, which, by the way, is the 20-period moving average. When we broke through that line, it was at that point resistance, and resistance was broken, and we rallied a little bit more before pulling back and bouncing quite nicely off of that moving average. Now, a couple of signs here. As I zoom in, you'll see that on that day when we bounced, that was a perfect bullish engulfing pattern, and the market continued into its trend. Now, that trend line is what I was drawing. So I took the low from November and I connected that pretty much to the low in December and tried to connect as many of these low points as possible. If you've never done that before, then the best thing is to take a line and try to connect as many of those points, or get as close as you can to as many points, and extend the trend line out. What's happened recently is that we're seeing a very a pronounced accumulation, if you will, of bearish engulfing patterns here and red candles. So last week I put out an alert that I thought that this trend line was being threatened, and that if we did break down below that trend line, we could see lower. And last week we were down almost 400 points. Just on Thursday alone, we were down 350, and we started to see smaller candles. Now, what do I see now? As I mentioned in last week's report, what I think is happening, this is a perfect doji slash spinning top. This is a sign that we could see a little bit higher prices towards the end of the week to fill this gap. Now, don't get too optimistic about this market right now, because if you look at the diamonds and you look at the spiders, that's ticker symbol SPY, that's the S&P ETF, you'll see the same thing is happening. We broke down below the trend line for the spiders, and we're starting to see these smaller candles. Now, what that means is that we could see a short covering effect. Now, again, I'm going to stop and pause every now and then to explain these terms that I'm using because it's very important that you understand what I'm talking about here. When the market starts showing signs of negativity or selling pressure, short sellers, which by the way are very short-term traders, they start to sell stock short. Again, if you've never taken a short position in your life, understand that this is when a trader borrows stock from their broker and they sell it in the open market with the agreement that they're going to pay back that loan. So these short sellers take the stock that they borrowed, they sell it, and their goal is to wait for the stock to drop lower before they buy it. Because if they could buy it at a cheaper price, then they repay the stock to the broker and they keep the difference. Now, when you have short selling activity, especially when its stock is breaking down below a major trend line, short sellers come in to cover or buy back the stock so that they can cover the loan. And what happens is the buying effect pushes the stock up just a little bit. So I think that on the SPY, the spiders, and going back to the diamonds, I think we'll see some short selling covering, which could push the market up slightly back to fill this gap. Now, once that happens, I am announcing to you here tonight, and don't think that I'm claiming the world's coming to an end, because it's not. But when this gap fills, I think it's going to be game over for a little while for anyone thinking about taking a long position. I call that the kiss of death. When a stock breaks down below a major trend line, like we see back here, I'll zoom in, same thing happened back here, broke down below a trend line, it bounced back up to fill this small little gap, it tested the trend line, and then boom, it came slamming down. That has happened over and over and over. If you look back at trend lines, even on the weekly chart, you can see that this has happened week after week in these breakdowns. So here's a bearish engulfing pattern on the weekly chart. Now this is going back to 2011. Bearish engulfing pattern, broke below the red trend line, went back up to test that trend line, failed. There's a kiss of death right there. Again, moving on, broke down below the trend line, went back up to test the trend line, boom, failed. Kiss of death right there again. So we're seeing this same effect. Back here, we didn't have a kiss of death. It just kept going down. Now, this term, the kiss of death, is something that I came up with. It's not going to be found in any other books except for mine, but it is a sign of negativity when the short sellers come back in to cover their shorts and the market fails to get back up over that trend line like we saw in the daily chart here. Then the short sellers take a secondary position and they take the long ride down. And that's when they're going to hold their short positions a little bit longer than just making this a short-term trade like we're seeing here today. So we're seeing that in the diamonds, we're seeing that in the spiders. Look at the Russell 2000. This is a more broad-based index. And again, it backs up to what I'm thinking in a short-term rally for the spiders and diamonds. This is very close to a hammer pattern. Now this is the Russell 2000. It's a more broad-based index. And you can see that, yes, we did have negative signs. We had a gap down. Here's a gap right here on the Russell 2000. But we're seeing a very close to a hammer pattern, close to the trend line. So what I think is going to happen is I think the Russell 2000 as well is going to go up, test that line, fill the gap, and then come back down to eventually break down below the trend line. Now this, by the way, is being recorded. Right now, as I speak, this session is being recorded, so if you're listening out there in the future, you can look at your charts to see whether or not this line actually became the leading path of things to come. So check on this. I always invite people to check on the reports so that they can, with their own eyes, see the accuracy in what I'm saying. Now, I'm going to switch gears a little bit, and I'm looking at the VIX. And I mention this almost every single week in the weekly market report. The VIX is one of the most important leading indicators that you can keep an eye on. And again, many of the traders I speak with are familiar with this, but then again, there are some who are joining us for the first time that don't really know the power of the VIX. The volatility index is simply a measurement of the volatility of the S&P. Option traders love watching the VIX because option traders thrive off of increasing volatility and decreasing volatility. There's lots of strategies that option traders can put on, which, by the way, I teach to our Option Oracle subscribers. Those members who subscribe to that service get a weekly lesson on option trading, and I talk about the VIX quite a bit there as well. Now, look, the VIX is a contrarian indicator to the S&P. What does that mean? Well, when the market is getting ready to drop, the VIX will be on a low. So in other words, when the S&P is on a high, the VIX will be on a low. When the VIX starts to rally, that means the volatility is shifting higher, causing turmoil or agitation or stress, whatever you want to call it, in the general market. So when the volatility starts to go up, it means that the investors are getting a little antsy, they're getting stressed out, and as the volatility index continues to rise, you'll see that many people will have less of an idea or less of an interest in holding on to the stocks that they own. I mean, it makes sense. If you're an investor and you've had a great run over the past year in a rally, why in the world do you want to give up those profits? If things are looking uncertain, what are you going to do? Well, hopefully you're going to be taking profits and moving to cash to protect your investments. And that's something else that the volatility index measures. Now, again, backing up what I said before, what do I think the Dow and the S&P are going to do in the short term? Probably rally to the kiss of death, and then it's look out below. But watch, if the S&P and the diamonds are rallying, it means that the VIX might have to come back a little bit to fill this gap. So here's what my projection is looking at. We closed right at the bottom of that red candle. This is what I think the VIX is going to do. Actually, I could do a better job than that. Hold on, let me get rid of that line. I'm going to draw this exactly the way I see it happening. Boom, and then it's going to, there's a gap right here, and then I think it's going to head back up this way. So that's what I think the forecast of the VIX is going to look like. Now, remember, if the VIX starts to go up from this point after the gap fills, you need to take your positions, check them, manage risk on them, and maybe even move to cash on a lot of them. That's my recommendation to everyone on the call right now, because if you're not managing risk, this could be an awful time throughout the rest of the summer. Take a look, and then I'm going to start taking some questions and stock symbols, by the way, so be ready. I'll put them in yet because they'll get washed away already. All right, let me look at the, I want to look at the diamonds, but I want to show you something on a monthly chart. This is a 10-year chart of the diamonds. This is 10 years. Now look what's happening. Look at the rally that we've had since 2009. After the crash of 2008, we've been in a significant upward trend. Now, look at the volume down here. Look at that. Isn't that interesting? Look at, maybe I could zoom in here for you. Look at the volume decreasing. Since 2009, the highs on the volume have been steadily decreasing. Now, I normally don't look at a 10-year monthly chart. Once in a while I check on it, but this is significant because when you have such a massive and steady volume drop in the market, that tells us that slowly but surely investors are losing their interest. They're no longer buying. If they were buying at the top, you'd see the volume increasing, but they're not. A lot of people are just sitting on the sidelines doing nothing. And that is reflected in the decrease in volume. Very, very powerful signs that we're seeing here. That's number one. Number two, look at this two-pattern monthly candle. Can anyone tell me what that is? I'm going to be looking on the charts here to see if anyone can identify that two-candle pattern right there on the monthly chart. Anyone want to identify that? Okay. Jan, thank you. That is a bearish engulfing pattern. That's right. Bearish engulfing pattern. Ken, you got it right. Shannon, you got it right. Yes, bearish engulfing pattern. Now look back in history. You don't normally see that many bearish engulfing patterns on a monthly chart. There are about 4 of them in 10 years. Look, I'll identify. Oh, let me get rid of that line. Here, let me go back and try to get a better price level. Now let's see if we can identify them. Look at this one right here. This occurred in September of 2008. Bearish engulfing pattern. Look what happened. Bam, it dropped. Here's another bearish engulfing pattern right there. Now, it doesn't look like much on the chart, but that's when the Dow dropped from 8,700 all the way down to 6,500 on that bearish engulfing pattern. Then another bearish engulfing pattern. The market went from 11,000 down to around 9,700 right there. Now look again. So, oh, let me get rid of that line. Can you see it? Come on now. Can't shake that line. All right. Then we saw. I'll have to drop it right at the top there. Okay. Then we saw another bearish engulfing pattern right here. Doesn't look like much on the chart, but the market dropped about 1,000, almost 1,500 points after that bearish engulfing pattern. So what does that mean? In 10 years, 100% of the monthly bearish engulfing patterns follow through with significantly lower prices. Now here we are again. We're nearing the end of June. There's only a number of days here left, about a week to go before July kicks in, and my guess is that the bearish engulfing pattern is going to hold. So if the market, let me get rid of all these lines now, delete all drawings. Okay, if the market breaks down, my next level of support is going to be the former resistance area. Okay, here's what I think that could actually wind up happening. Here's a former resistance area. Once broken, turns to support. Now, I'm not making any outrageous pictures here. This is exactly what we can see happen before we even find a level of support. What is that number right there? Well, that's very, let me get my drawing back on the price level. That role reversal point right there is right around, let's see, that's right around 136 for the diamonds. So you could see from here, you can easily see a 1,000-point drop in the Dow, because remember, the diamonds is 1/100th of the Dow. That's how this works. 146 is 14,628 right there. We can easily see a 1,000-point drop in the Dow. And it'll still be in its upward sloping trend. You see, you have to understand that these lines that I'm drawing, this is textbook technical analysis. Here's a low, connect to that low, connect to that low, project out, boom. Look, see how I drew that pivot point? Why did I draw it right there? Because that's where I see in my mind's eye, I always saw that trend line forming. So this, again, I mean, I could only do this so many times and hope that people are listening, but the percentage of accuracy in my forecasts are extremely accurate. It's very high, and I hope that you're adjusting yourself correctly, especially with managing risk. Now, if you're an investor and you say, you know what, AJ, I think I'm going to hold on anyway. You know, I could weather the storm if it's a 1,000-point drop. Yeah, that might be true, but what if that support level doesn't hold? Well, if that support level doesn't hold, then you could see prices drifting all the way down to Dow 10,000, because this line can be projected down further, as we saw back in this angle of sell-off back in 2008. Now, again, I'm drawing this on a monthly 10-year chart, so I'll do my best to keep these lines on, so that I'm not going to publish that because there's too many lines, but I'll use this for reference next month when we go through our monthly web seminar open house. Okay. All right. Now let's see. Here's let's see. Questions are coming up. Let's see. Gil says, AJ, you mentioned correction. How about a real disaster possibility? Well, Gil, you know, again, I don't want to claim that the sky is falling, but there are signs on the horizon that lead me to believe that this could be much worse than just a typical correction. And I'm not going to get into that right now, only because the signs are not showing a major breakdown in the monthly chart, but that could very well happen. Now, when you see a bearish engulfing pattern, Gil, on a monthly chart, you have to adjust your strategies to accommodate a bearish market. And that doesn't mean you have to just short sell every stock imaginable. Remember what I said about the VIX and how that's a contrarian indicator. Well, if you're looking for something to buy, remember that the VIX will go up when the market goes down. So instead of buying the Dow when you think it has the possibility of going down, look for pullbacks in the VIX and play the VIX from the long side. Again, you're getting an opportunity to buy something, and that will help you. Another idea, and I'll go to the weekly chart here on the UUP. The UUP is the dollar. It's the U.S. dollar. Now look what's happening in the UUP. I think, and we took a position, by the way, in the UUP. My subscribers on the Equity Oracle, I gave them UUP as a buy candidate last week. Now look at this. We have a bullish engulfing pattern, a big one, on the UUP. So if the Dow is dropping, it doesn't mean that the dollar is going to drop because the Dow's dropping. In fact, it could be the opposite. I've seen the dollar rally tremendously in down markets with the Dow, because think about this. What happens to the U.S. dollar? I'm going to give you another test question here. Generally, what happens, and there's a delay here, so I'll wait for the answer. What generally happens when the Fed? What happens to the dollar generally when the Fed increases interest rates? When they increase interest rates, what generally happens to the dollar? Does it go up generally, or does it go down? Mike says it gets stronger. Mike Ehlert says it goes up. Ken says goes up. Okay. Shannon, yes, you're right. E. Dean, dollar goes up. Why? Well, that's the reason why the Fed increases interest rates. The reason the Fed increases interest rates is because they want to make the dollar attractive to those who are trading the dollar. If you buy the dollar and you're getting a higher interest rate, then you'll buy more dollars. You see how that works? So the Fed raises interest rates to try to curb inflation, because that's generally what happens when there's an inflationary threat. The Fed will start to strike early, a preemptive move, and they will go ahead and raise interest rates to support the dollar. So if the interest rates go up, a lot of times you'll see the Dow drop. Well, if the Dow's dropping while interest rates are going up, you could buy the dollar. Again, another buy candidate there for you. Now, you can see that you're not going to be getting extremely wealthy just holding the dollar, because we put the buy recommendation out when it was trading around 22. I'm already looking to sell it at 23, or prices at the top of resistance. So percentage-wise, you talk about 3.5%. Not a big deal. But when you're trading it actively, those 3.5% gains could wind up becoming very attractive over time as you accumulate that. Okay, I'm going to take one more question, and then we're going to go into the stock analysis. Is there another question? See, Shannon says, there is a big gap in the markets in January 2013. Do you think it will fill? I am short the SPY and the QQQ. I'm hoping so. Let's take a look, Shannon, and see what you're talking about there in the SPY. Let me go back to that. Now, that was, I imagine that was in the daily chart. Okay. Here's an open gap. Let me get my trade price lines there. I'll show you, Shannon. Okay. Here's an open gap, Shannon, right there. I think this gap, let's take one gap at a time. I think this is a real strong possibility that the spiders can fill that gap. I don't think it's going to happen this week, although I could be wrong. I still think this small candle is going to cause us to go up a little bit before going back down. Russell 2000 is pointing a little bit higher short term, and so is the Dow. So on the Qs, if you're short both of these, I would still be playing from the short side. But if you're short the Qs, I would probably be buying those back, because you got a gap up here. You have decrease in volume. Let me stay on that for a little bit. Folks, if you see red candle, red candle, red candle, red candle, remember this is a daily chart. There are 4 red candles in a row. Test question. Here we go. When was the last time in the Qs on this particular chart that we're looking at, when was the last time we saw 4 red candles in a row? Ready? Waiting for the answer. Anyone see it? Well, it's a trick question because there aren't any. And since the since the beginning of the year, we have not had 4 successive red candles in a row until now. So what does that mean? It means we're long overdue for a green candle. So Shannon, I think it would be very wise for you to cover your short in the Qs, wait for it to go back up, fill the gap, and then I would look to take a new short position. Okay. This, by the way, red candle, red candle, red candle, red candle is called a stale red light, and that's kind of like when you're driving down the road and you're looking at that red light right way ahead. As you approach it, eventually it's going to turn green, so we call that a stale red light. You've seen stale green lights too. We had a series of those, but we've had many more successive green candles in a row than red candles. So again, we're long overdue for a green candle. So again, short term. All right, let's see. Paul Farley says, when should we be buying gold and silver? Well, Paul, I have been buying gold and silver. I'm still buying gold and silver. I made a recommendation last week to buy silver to the Equity Oracle subscribers. Let me show you this on a weekly chart. This is gold, by the way. Let me go back. Let me zoom out a little bit. Actually, let me go to the monthly chart on gold. It'll be easier for you to see that. This is a monthly chart on gold, being that Paul brought that up, and I'll show you silver in a second. Right here is an area of former resistance. It's a small little pivot point. Remember, this is a monthly chart. On September 2010, we broke through resistance, and now we have 1, 2, 3 months, mind you, in a row. Now, we've had a long stretch of red candles here. We'd have very small green spinning top that kind of broke up that long red. But we're in gold, this is very much a stale red light. We're long overdue for a green candle here. And we are exactly, Paul, we're exactly at that role reversal today to the penny, 123.42. So we're right there. So Paul, I am a buyer of gold. I think that eventually the Fed is going to have to do something to offset the threat of inflation. I don't think we're going to see a QE12 in our lifetime, although, again, I could be wrong on that one too. But I do believe that the Fed is done with the quantitative easing for a while, and something's going to have to shift. Gold is a world currency. It always has been, and I think it will for our foreseeable future. Silver is also an industrial metal, not just a precious metal. And you can see that if I go to a monthly chart on silver, I have a role reversal. Again, let me get rid of some of these other lines because I was using that in my video report. Get rid of this one. And let me get rid of this one up here. All right. This, again, is to the penny on the mark of that role reversal. So silver is a very, very attractive buy. We have 1, 2, 3, 4, 5, 6, 7 months in a row that has never, 7 months of red candles has never happened until now in a decade. So again, I think silver is a screaming buy at these levels. I'm looking at the monthly chart again, remember. And if you look at the weekly chart, you'll see that there's a gap up here around 25 for silver. Percentage-wise, listen, you could hit a home run here just by the stock filling the gap or testing the 20-period moving average. You don't have to be really going out on a limb. I'm a scaled down buyer every dollar here. Even my support level, I have a low support level even down to this. This is my stop. I'll be buying silver all the way down to 14.5. I think this is a great accumulation area right in here, and I'm going to continue to buy it. So I'm not just telling you to do it for the sake of doing it technically. I'm doing it as well. I'm right there in there with you, Paul. So okay, what I'm going to do is open up the lines now to the stock symbols. If you want to put a stock symbol in there, I'm going to take them. Wow, they're starting to come in already. Dave says ABB. Let's take a look at that one. Let me get rid of that. That keeps popping up. I say buy it. Okay. Right now, ABB Limited is an ADR. Reason I say buy it, I mean, my eye can identify this pretty quickly, and why I think you should buy it. Number one, you're at a beautiful roll reversal point right there. Resistance, see that resistance was broken, is now turning support, very close to the 20-period moving average. I love that. You have 1, 2, 3, 4, 5 days, this is weeks now. This is 5 weeks in a row. This one's been down. We now have a green candle. I say buy it and put your stop somewhere below 20. I wouldn't ride that one too far down, only because the support level for this one is down. The next support level in the roll reversal is down there below 18. So I would say if you're buying this one and you want to put a stop, put the stop somewhere below support, which is right below 20.31. $20 or maybe 19.98 is a good stop level. The power of even numbers or power whole numbers is right why you don't like to put your stops on a rounded number. Put it like a crazy odd penny number, and then it'll be better for you. But say 1997, okay? And I would get out over that one. So Dave, that one looks real strong for you. Okay, Igor says URI. He's a short position. URI. I'm looking at another roll reversal coming up here, Igor. So be careful, because this roll reversal is going to coincide with the short-term trend. Let me show you how to do it. I'm taking this low. Again, for those of you who have never drawn a trend line before in your life, here's a lesson of monkey see, monkey do. You take the low point, you take a line. You have a lot of programs have these pencils that you can draw on, and so you try to connect this area here, and you try to connect as many of these dots as you're progressing out. You see what I'm doing right there? And lo and behold, look what happens. You get this one, this one, this one. They're all kind of sinking into this roll reversal trend line area. So I think a short idea at this point could be very dangerous. If you already have a short position, Igor, then I would cover your short. Igor, if you could, tell me, you're already short. I'll look for your answer in there. Are you already shorted, or are you thinking about shorting it? If you're thinking about shorting it, I would abandon that idea because the move is over already. Okay, you already shorted it at 48.60. Yeah, I would definitely take your $2.50 or $2.40 profit, take that profit and run, and then wait for the stock to get back up to an area of resistance before selling it again. I think this one will bounce and probably give you another chance for a short position. Okay, I like that one. Okay, next stock. Now, for those of you who put in stock symbols already before, it's already washed off my screen. Okay, Michael, thank you very much. Michael says, is it too late to get out of FIG, or is it a buy? So let's see, FIG. Okay, now I'm looking at a weekly chart. I don't see any roll reversals. It's already past this roll reversal here. So I have to look now at a daily chart. All right. You know, Michael, I don't like this right now because, number one, yesterday it closed, Friday it closed significantly lower than that trend line. That's number one. And number two, I'm seeing a sign on the chart that is telling me that the sellers are still very motivated. Can anyone tell me what that signal is? Can anyone tell me what I'm looking at that's confirming that the sellers are still in force? Is anyone? Okay, yeah, wow. Got a lot of good students. Steve, Karen, Jeff, Pat, Dave, Alan, Mike, I'm reading off, Shannon, Lloyd, yeah, beautiful, Edeveldo, Laura, you got it. Everyone who's been paying attention to market guys knows that when the red candles are showing and the volume is increasing, you see the volume down at the bottom? That's a sign that the sellers are still in force. Now, here's what you have to watch for. Before you even think about buying, you have to look at the next volume candle. And if the next volume candle looks like that one that I just drew, then you would start thinking about getting out, because when the volume drops, it'll tell us that the sellers are losing some of that motivation. Got that? Now, this is a very technical stock. It follows the technical signals very well, so you cannot ignore the volume play that I just put on here. I'm going to delete that so it doesn't, fool yourself there. That is lower volume already. Now, you have a bearish engulfing pattern back here. Look how beautiful this is. Boom, bearish engulfing pattern, the stock dropped. You came very, very close to a bullish engulfing pattern here. Stock rallied. The stock continued to rally before seeing another bearish engulfing pattern. Bearish engulfing pattern, it failed miserably. It dropped. You had another bearish engulfing pattern right here. Now think about this. If you were long anywhere back in June, in late May, June, and even into the end of June here, and you see bearish engulfing pattern, bearish engulfing pattern, bearish engulfing pattern, why in the world would you still be holding on to that stock? I mean, again, we're looking back at the history of the stock, and it's obvious now. But when you see a stock that's reaching high resistance points, and you see bearish, bearish, bearish engulfing pattern all over the place, get out. And then when you finally gotten out of your stock, short sell it. Short sell it, because then if you short sold the stock, you can get out with a buy stop above the market to cover your short position. That's the way to trade. And if you didn't get what I just said, then make sure you go to the Market Guy's website, click on the video link, and there are lessons there for you to watch. These are free market shots. I call them market shots. They're daily educational vitamins. These videos are only 4, maybe 5 minutes long. I think the longest one is 5 minutes. So you're not going to overwhelm yourself with information. Go and look at engulfing patterns. I just talked about that one. Go and look about the 20-period moving average and how significant that is. Go and look at the dojis and spinning tops. These are all the role reversal, very, very powerful. I've talked about these already in 37 minutes, and there's much more to be learned on this particular website. So make sure you're using your resources to go ahead and learn and become a better market trader. Not just an investor, but a market trader. Okay. Barbara, ALKS. Barbara, do you have a long position in ALKS? If you could, I would like to know what your position is so I could help you better. ALKS still has a little bit to go before this gap fills here. Let me just go right there and draw that line. Get my price level in place again. Okay, here's my role reversal, probably around 26. Excuse me, my gap fill support rather. Now, I don't know if my partner is hearing Bill Shanley. We were adding the gap, trading the gap video back onto the website. We're going through a website redesign, and I think we misplaced that video. But here's the importance of a gap fill. When a gap fills, the fill point, which is this red line, will act as support. Now, interestingly enough, Barbara, let's see if you have it. No position now. I wouldn't be opposed to buying it, but you have to wait for the next high. So here, let me explain. Let me try to draw what you need to see. You need to see a green candle that has a higher low and a higher high. It doesn't have to be a crazy big green candle. It could be looking as small as that one right there. Imagine that being green. The thing you want to look for is a higher low and a higher high. That will signal a pivot point. Now, try to take a mental picture of that because I'm going to erase it. You're looking for a candle that has a higher low, higher high before you buy it. That will signal the pivot point. Now, watch what happens here. This red candle had a lower high and I think almost a lower low, but it still had a lower high. This had a lower high. This had a lower high. Today we had a lower high. So the sellers are still pushing it down. Even though it's a green candle, the sellers are still in control. Don't be fooled by the color. We're still seeing lower low, lower high. The definition of a downward trend are lower lows, lower highs. And you can look that up. That's the exact definition of what a downtrend is. So you're still technically in a downtrend. Wait for the pivot point to form. When it forms, I think you're close enough to this gap to expect a short rally, because right here you have another gap, which will be your target. So if you buy it here, I would probably already be thinking about selling it about 28.75 or 29. This would be just a quick 4% profit and run. I wouldn't be sticking in this one as an investor, because this is a trading stock right now. Okay, hopefully that'll help you out. All right, now Caesar says, thinking about shorting HPQ. He's asking for my thoughts. I love the idea that people think about shorting, because that's what I'm talking about here. Caesar, now let's analyze this step by step. I'm going to think out loud as I'm looking at the chart, so you could understand what's going through my brain. Okay, the first thing I look at are the color of the candles. What color are these candles? They're red. Okay, so chalk that up as a negative point for the bears. All right, or a positive point for the bears, whatever way you want to look at it. The bears are winning this one. They get extra points for having big, long red candles. The second thing I'm looking at is a gap. See, there's a gap down here. Can that gap fill? I think that gap will fill eventually. I also think this gap will fill eventually. But before I can bet on the gap, I have to look at the volume relative to the price and the color of the candle. Now, what's happening with the volume? Can anyone tell me? The volume is dropping. Now, remember, folks, Caesar is thinking about shorting the stock. He didn't say, does it look like a buy? He's thinking about shorting. He wants to make money on the way down. Do I think the stock can go down? It can, but this gets in my way right here. If this red candle was higher today, I would say the sellers are still very much in force. But today we had lower volume on the sell side. So what could happen is this stock could go up like this before coming down. Now, Caesar, if you're okay with holding it even though it goes up, here's what I would suggest you do, because hopefully you have a stop point. This is a role reversal support level. That's why I drew that line right there. This is a support line that held until here when it broke. Former support, remember that role reversal that I showed you on the market guys right here? See that video? Watch that. Go watch that video and you'll know exactly what I'm talking about. When you see a role reversal support level broken, the role reversal support turns into resistance. So, Caesar, what you need to do is you need to put a stop somewhere above that resistance line if you're still waiting to hold it to fill this gap. Okay? So that's what I think you would do. If you're already short, if you've already shorted it, then put your stop. If you're thinking about shorting it, I would wait for it to go back up to pull back from the role reversal resistance and then take a short position at that point. But remember, the overall markets, longer term, are looking extremely bearish. So you want to keep these short strategy ideas in place so that you have a strategy instead of just buying and holding and hoping. Okay, I'm going to the bottom of my, I'm going to the Q&A box down there, and Gordon says TBT. He's up 9% and want to buy more. I think long rates will rise. Well, that's the T-bill. If you take a look at the T-bill here, TBT. And this is a 20-year Treasury. Well, let's think about this for a second, Gordon. You're up 9%. All right, that's congratulations. That is a great thing. There's also a saying that I teach quite often, and here it goes. Ready for this? Hope you can handle it. I think you can, but here it goes. Never turn a winner into a loser. All right, what do I mean by that? Let's analyze this one very carefully. Look at this trend line. Bingo. That is a trend line, folks. Actually, I could probably go steeper than that. That is a trend line. That is as close as you're going to get to a vertical trend line. Now here's what happened. Gordon, I would suggest you take your profit and wait for this gap to fill. Here's what I think is going to happen. Watch, I'm going to draw this out for you. Let me take the trend line away. You've already seen the extreme level or angle that that one's posting at that point. But here, let's analyze this very, very carefully. TBT, which is the short Lehman 20-year Treasury, this is very, very technical. When you're dealing with T-bills, treasuries, interest rates, currencies, you have very little fundamentals to go on, and you have to go with technicals. Back here, what do you see? Bullish engulfing pattern. What happened? Stock went up. What do you see here? Bearish engulfing pattern. What happened after that? It went down. What happened here? Bullish engulfing pattern. Bearish engulfing pattern. What happened after the bearish engulfing pattern? Went down. What happened after the bullish engulfing pattern? Went up. So we have bullish engulfing pattern, extreme upward move, vertical trend, gap along the way. Now we see a red candle on lower volume. Everything on this chart is screaming sell. Now, it doesn't mean sell everything you own. It means sell, take your profits, wait for the repositioning, which could very well look like this. This is what I think could happen, just like that. Now, look at how I drew the lines. Can anyone tell me why I drew them that way? I could have drawn them any way I wanted, but why did I do it that way? Because if I connect as many of these as I can, there's the longer term trend line here. This is a short term trend line that I drew, the vertical one. This is more manageable. 45-degree angle of trend is sustainable. Now, I think it could come back, fill the gap here, and then I think it could bounce and start going back up. Now again, please, this ticker symbol is TBT. If you're listening to this out in the future, do this every week, talk to the people in the future in our time machine. If you're watching this video out there in the future, pull up TBT on your charts right now and look at to see if these lines were true. Okay? You will know that out in the future more than we will right now in the present. Okay, now everyone's mind is flipped out in the time travel. Let's get back to reality. We have Jan Silverman says Amazon, excuse me, AMZN, okay? AMZN, Amazon. I would, hold on, let me see what Jan's question. Amazon, I'm long the January 230 puts. Do you think it's going down? And if so, to where? Wow. Oh, let me get my crystal ball out, Jan, and let me draw some more lines for you. I'm going to delete all the drawings at this point. Let's take this one step at a time, and we'll use Jan's question as an opportunity for us to study technical analysis. Again, let's look at the charts. What's the first thing I look at? Do you remember what I said? I look at the candles. I look at the color of the candles. 1, 2, 3, 4. And then I compare them to the past. When was the last time we saw 4 red candles in a row? That was back here in March. 1, 2, 3, 4, 5. They had 6 before it started to rally, and then it rallied furiously. So that's number one. I see 4 red candles in a row. 1, 2, 3, 4. What's the next thing I look for? Well, I look for a gap. There's a gap down there. I don't know if that gap is going to fill so quickly, Jan, because here's why. What's the other thing I look at? Everyone answered that question before. Do you remember what that was? Volume. I look at the volume. Now let's analyze that volume. Okay? Hold on. Is the volume higher or lower than it was on Friday? Jen, these are very simple things that you have to rehearse. Unfortunately, if you're long the put, the odds are you're going to lose money on that. So you have to pay attention to the technicals. These are the same signals that I've written about in books, talked about in seminars, talked about on television and radio. Same thing. I look at price and volume. Price and volume. Price and volume. I don't need to say any more. I look at price and I look at gaps on the price. That's all part of price analysis. So I'm analyzing price. I'm looking for sequences. I'm looking for past historic patterns to see How many in a row? How many bearish engulfing patterns, bullish engulfing? I'm looking at that. Price, that's all price analysis. Then I look at volume. The volume is lower. Okay, here's the other part of the test question, folks. If the volume is lower after a series of red candles, what does that tell us about the seller's motivation? Is it higher or lower? Are they highly motivated or less motivated to sell when the volume is low? Okay. Lower. Lori, Nash, lower. Shannon, less motivated. Ken, lower. Absolutely right. When the volume is lower, it means that the selling pressure is lower. The motivation of the sellers is lower. So, Jan, I would get out of the puts, take a profit if you have it, and then get out and reposition on the puts. Finally, before I get to another stock, look at this candle. This is a significant hammer pattern. A hammer pattern is a small-bodied candle with a long shadow beneath the body at the end of a downward trend, short-term downward move here. Here we go. 1, 2, 3, down, red candles, long shadow. Now, I know lots of people that will only buy stocks that have long shadows underneath them. Hence, here's another one, hammer pattern. A small-bodied red candle with a shadow almost 2 or more times longer than the body is a hammer. So here's a hammer, here's a hammer. Here's a hammer, here's a hammer. What happened on those times, back-to-back hammers? It rallied. So not only do we have a stale red light on lower volume, we have a hammer pattern. Chances are stock is going to start moving up. Boom. Next resistance point for Amazon is 282. Okay, I spent a lot of time on that one. I'll move on to the next. Anyone want to pipe? Oh, tongue-tied there. Anyone want to put in another stock symbol? At Evaldo, we have GILD. GILD. Let's see. Evaldo, could you please tell me what your intentions are? Are you buying or selling or... Let's see. I'm waiting for that answer. I know there's a little delay. Evaldo, let's see if you... I don't see your... Oh, there. You're long the $30 calls. Long 30 calls, short 45. Oh, okay. So you're long a call spread. I love this one as a call spread. I think you... I don't know what month you have, but I love this one as a call spread because... Let's analyze price and volume. Ready? Here we go. Green candle after a series of red candles and a bearish engulfing pattern. All right, here we go. Let's analyze price. Now, note here I have a support level already on there. One, yeah, bearish engulfing pattern here, followed by a downward move here. So you have a downward move and volume. What's happening to volume? Volume is lower. Okay, keep that in mind. We just answered this question. If the price is going down, if the sellers are in control, and then the volume drops, that means the sellers are becoming less motivated. That is a positive if you're a buyer. Number two, you have a hammer pattern. That's bullish. That's very bullish. Like that. So you're long the 30s, short the 45s. That's a $15 debit call spread. You should be okay, especially if it's a July option. You should be okay because what I think is going to happen is I think this particular stock is going to rally from this point and most likely stay over the $45 area. I think you could very easily see this happen after this. Now, one thing you have to understand, Eduardo, is that you want the stock to stay over 45 for you to profit. That support level is right at 44. So this red line that I drew back here is going to actually protect your call spread. Now, for those of you who do not know options, or maybe you've never even heard of an option, we at the Market Guys do have our option service. These are the oracles. I'm sticking in a plug there because I love writing these reports each and every week. I love them. High percentage of accuracy. There's a video there that'll explain what that's about. But these are educational services. These are not just AJ Monty's going to call you up. No, it doesn't go that way. These are educational services. I just don't write a stock trade alert for you. I give you the trade candidate, and then I educate you on why I'm giving you that candidate. You see, I want to teach you how to do this so that you can become good at it and make money. That's the whole point. So if I'm talking options and you want to learn options, let's go for it. We're in this together. I'm the provider. Bill Shanley puts out the educational information through our member page, and we have a great time, and that's the way it goes. Okay, I have time for one more stock. And who's the lucky person? That's going to be SDS as a hedge. Okay, George Popoff, let's see. Oh, let me get rid of that. SDS. Now, for those of you that do not know what SDS is, that is a short ETF. And what happens is it's a leveraged short ETF. Now, you got to be careful with the leverage ones. I don't have time to get into the minute details of what that is. But let me tell you, George, got to be careful on the hedge. Here's why. You could see the market dropped recently. This is a contrarian indicator or contrarian candidate to a long position as a hedge. So if the Dow goes, the S&P goes down, this is going to go up. But remember what I said about the S&P. I think it's going to rally, which means this one could very well drop, fill the gap before going back up. Now you have to be careful with a hedge, because if you buy the SDS, and let me just show you here. I got to show you something. It's very important that you know this one, George especially. Let's say you buy SDS, and it goes up. Whoa, you're a hero. And let's say the next day it goes right back down to where you bought it. Let's say it does that. Guess what? It could be at the exact same place that you bought it a day later. The market, that is, could be exactly where it was, and you could still lose money because they market its percentage of the close of that day. Again, look at the prospectus on this one so you know the details. So, George, I don't like SDS as a hedge because there are some caveats there that can get you into some trouble if the market just fluctuates or oscillates. However, the perfect hedge, George, if you're looking for perfect hedges, that's found in the option markets. So if you if you want to look for a real hedge, that's the way to go, in my opinion. I've been trading options for over 30 years, so I'm partial, obviously, to that instrument, but I'm willing to teach you. So anyway, I'm looking at the clock. We're 2 minutes to the top of the hour. Let me make a quick announcement here, folks. Number one, we had a really good list today of people showing up. I don't know if you could see the number of attendees, but the number of attendees are growing. Please do your best to spread the word about the market, guys. This is a free event. It's free. I'm telling you, people pay me lots of money to give them advice. I'm giving this to you right now for free. We do this once a month. Our membership is very, very inexpensive. The cost of what a trade candidate will be to you versus the benefits is tremendous, because the value of the versus the cost is tremendous, because all I have to do is pick good stocks, and at $149 a month, if you follow the instructions, you'll be making more than that each and every month to pay for your service. So it's a no-brainer. It doesn't cost you anything if you're trading successfully. That's the whole point. Follow the rules, manage the risk, and move on. And this is a market where it's going to be very difficult for investors to hang on. You have to find alternative ways to put your strategy together in this market and stick with it. And it'll help you sleep at night. It'll remove the stress and absolutely be a whole lot of fun. So I hope you had as much fun as I did tonight. That was one quick hour, but I'm going to sign off right now. Have a great rest of the week. We'll talk to you soon.